Hi everyone, welcome back to the Property Finance Podcast, and we're here for part 2 with Uliana. So get us started with, how difficult is it to obtain development finance for airspace development? It's a question that comes up all the time, especially more so recently, I would say, as people try and come up with new ideas of how to develop existing properties.
Very much so, in particular in London. Airspace is difficult, and the key is to find developers who are prepared to fund airspace.
Yep.
Luckily, those who are not prepared to find airspace are very clear about it. So the moment you knock on the door and you say, I have an airspace deal, they would say, no, thank you. And the no, thank you is more valuable and helpful than, oh, maybe we'll look into it and then I'll come back and say no later on, right? So there are a few developers that are prepared to fund airspace. I won't name the name, but I'll tell you later. But they have a specific process and specific hoops you have to jump through in order to obtain airspace finance. The biggest challenges with airspace, the many, but the biggest challenges is if you have an occupied building and you're building on top of existing building with people living in it. Because apart from disturbance to tenants, apart from health and safety, apart from putting scaffolding around existing building where people live and children live, you also have the rights of leaseholders that you trespass on. You create an inconvenience and nuisance, and they have the right not to be nuisance and not to be inconvenienced in the process. So any of them, if you do wrong move in a building like that, any of them can complain and enforce the rights.
Yeah.
It's an issue. You create noise, you create pollution, you create inconvenience to them. You want to park your vehicle somewhere and you block the parking lots. You want to put your materials somewhere and you block again the parking lots and no access to the building, etc. Another challenge is Building Safety Act 2022, which we should cover on later in the process here. That is very difficult to comply, and in fact there is a lot of ambiguity around how to comply. And then you have things like party wall awards. When we think about party wall awards, we think about neighbors on both sides of your property. But when it comes to airspace, the party wall awards become vertical between the upper floors and the lower floors. In particular, when we are building on top of commercial building or even just the residential occupied buildings. There is lots of issues around construction and creating the soundproofing and creating the airs. How do you separate the existing floors from the new floors, and you do this correctly, and you're building in the air. So there's lots of lenders who feel uncomfortable about this, and some lenders who are. So you need to be very clear what are the guidance. And then you have things like masts, telecommunication equipment that is on the roof, and it's there for a period of 20, 30 years. And the owners of those masts, they don't have to remove the equipment.
Yeah.
You need to reach an agreement with them about relocating that equipment. It could be costly, and it can take anywhere between 12 to 18 months just to finalize those negotiations. So there's lots of challenges with airspace, but there are ways to do it, and there are some lenders who will be happy to work with you on that.
And is there anything from a developer's point of view that they should really be looking for when trying to identify these opportunities? Anything that's going to make it easier for them going and obtaining development finance?
Nothing will make it easier. It's
I'm trying to find a shortcut somewhere.
Well, that's for a good reason. There is no shortcut. There's particular things that needs to be taken care of when you deal with airspace, and that is why majority of the airspace transactions, you don't purchase the airspace, you purchase an option subject to, and that subject to will be being satisfied with various requirements. Yeah. For example, the telecom equipment we just mentioned. Yeah. This can take such a long time. So if you purchase the airspace subject to removal of telecom equipment, then you can take the time to negotiate, and then you can take the time to relocate.
You're not paying interest and things like
Precisely.
that.
Precisely. And the site is there, secured, waiting for you, but you satisfy yourself with everything around it. And only if you're satisfied, you then complete the transaction.
So what's the difference between airspace and vertical extension?
Oh, that's a good question. So there is no difference technically. It looks the same. You're building on top of existing building. So visually, it looks the same. You're adding some floors on top of existing building. But some lenders have clear differentiation between airspace and vertical extension, where they call it vertical extension when you own the building, the freehold to the building, and it's vacant. If it's vacant, you can do whatever you want to it. You don't have tenants to deal with, you don't have leaseholders' interest, you're not trespassing on anyone's property, you're not blocking anyone's parking, you are in full control of the site. When you're in full control of the site, lots of the problems that you face with airspace development and leasehold interest
not going to have with that
disappear. Exactly. You still have to deal with your Building Safety Act, but beyond that, you have very little to worry about in terms of the challenges aerospace have. So when it comes to vertical extension, a lot more lenders will work with it. But when you submit the inquiry, half the time, not half the time, 90% of the time, the inquiry comes in and the brokers would call it airspace. So if you call it something else and you specify what is it, you actually have a better chance of getting a wider pool of lenders to support that transaction.
And really, I suppose it boils down to vertical extension is extending something you already own, something you're already in control of. Airspace development is essentially developing something that you do not control what sits underneath it. And that
comes down to it, correct.
I'll put it into the dumbest format possible. We've mentioned the Building Safety Act a couple of times. Let's talk about it briefly then. So how does it affect, from a lender's perspective, those higher risk projects and buildings? Buckle up. This one's going to be the fun one.
I know. Building Safety Act it's there for the right reason. It all comes off the back of the Grenfell disaster. But the execution of Building Safety Act, it has not been as smooth as we would have wanted it to be. So you probably know it came into force in summer 2022. So we're now November. We are more than 2 years after the Building Safety Act came into force. And unfortunately, majority of the projects that require Building Safety Act sign-off are stuck. So more than 2 years after it came into force, and they're stuck. And the reason they're stuck is because while the guidances were released, the guidances are not very clear, they're not detailed, and it doesn't tell developers what are they supposed to comply with in order to have Building Safety Act sign-off. So what I'm hearing, what I have learned from developers and colleagues that have tried to handle transactions that require Building Safety Act sign-off is there are a few things. First of all, within the guidance, they say that you can have a stage sign-off for the Building Safety Act process. But in reality, when you try to get the sign-off, the building safety regulators say, no, you can't. The responses developers are getting from building safety regulators are not around what you need to do to have the sign-off. They're telling you what they don't like about your submission. So then you go away and you try to figure out what might they like about my submission? What am I supposed to do with this submission to get them to sign it off? There's no clear guidance. What are you supposed to do? So in order to commence on site for high-risk buildings, you need to get the way to sign off from building safety regulator. By the look of it, in order to have that sign, it seems that the level of detail and the level of specification that needs to be submitted, it's equivalent to about stage 4 or even stage 5 construction preparation. Now, that for larger projects can take up to 9 months. So can you imagine those developers trying to get the gateway to sign off, and they need to have design team in place that they're paying to. They need to have a construction team in place on standby, and they don't have clear commencement date on site. Now, they also may have finance on site, and the interest is eating into the profits, and they're unable to commence on site. Now, I want to share with you an interesting number. An information freedom request was submitted to building safety regulators to see how many applications were submitted related to Building Safety Act and how many have been approved and what happened to the rest of them.
This will be an interesting stat.
Would you like to know?
Go on, I've got a
So
feeling.
the number is, it's astonishing, and that's why I remember it. The number is to 13th of June this year, 2024.
Yeah.
And the number of applications that have been submitted are 1,001.
Okay. So it's about 500 a year they've had submitted, yeah.
Out of this number, only 147 applications have been approved.
Wow.
Circa 300 have been declined due to insufficient information, and about another 300 are under consideration. The biggest problem is, A, it takes weeks and weeks and weeks to get any response from the regulator. But when the response comes, it does not have steps forward. It just tells them what the regulator doesn't like. So developers are now left in a little bit in the dark around, what am I supposed to do to have this approved?
Well, there's 250 submissions there from what you've just said, that there's nothing at all on. There's no rejection, there's no approval. They're stuck in limbo, aren't they?
They are. So now we're wondering, why are we not convincing on sites? Why the construction are, why we're not delivering on the housing stock? Now, of course, this is a small part of what we need to build to deliver the housing stock, but equally, it doesn't help anyone. And the people who pay the price are the developers.
Yeah. And is there anything that lenders can do to assist with those submissions?
Yes, we had we had a debate about this in CREFC Europe Construction Forum, actually, which was really useful. Lenders don't have clarity around what is required to discharge Building Safety Act 2022 requirements in exactly the same way the developers don't have the clarity. Yeah. So to a degree, they sit on the fence thinking, well, what am I supposed to do here? I don't have a commencement date on site. What am I finding here? How can I find somebody when I don't know and nobody else knows when they're going to commence? Now, we had a little debate around, can we do anything and should we do anything? And the reality is, in this industry, we all support each other.
Yeah.
When lenders go conservative and decide to just wait, everyone pays the price. So there are multiple things lenders can do. And we can think about potentially advancing lower loan to value day one against the site to allow us the waiting time and not defaulting the client for not commencing on site because they're waiting for BSA 2022 sign off. It's not the client's fault, and it's not for a lack of trying. Maybe we can come up with an arrangement where the client will service the interest while they wait for the sign off.
Yeah,
they're already fitting the bill, they're already paying for the design. Extensive design, advanced design, so they're already kind of bearing the toll of the new regulations. But the lenders could be a little bit more flexible around not penalizing the developers and not defaulting developers because they failed to commence due to those regulations. The regulations are there for the right reason, but unfortunately, the way the whole system was implemented did not help anyone. We do hope and expect that the situation will become better. The more applications go through, the more approvals we get, the more clarity the industry will get around what is actually needed to have this all done properly.
Talking of delays then, so there are a few bits that could cause delays to commencement on site. So one of them being literally pre-commencements. So in terms of pre-commencements, there are some lenders who will allow some of those pre-commencements to take place after completion. There are some lenders who want all of the pre-commencements, obviously the ones that reasonably can be done, all of them ticked off before they draw down on the finance. From your perspective, I mean, first off, it'd be good to get your opinion on whether all those pre-commencements should be done prior to drawdown, and if so, why, and if not, why. But then also, why is it important to have that period of time within the development finance to kind of allow that to take place as well?
That's a good question, because some lenders don't allow pre-commencement period, and not because it's not needed, but it just sort of it's not built into the product. Development finance proposition itself is designed to fund development, but we do need to be mindful of the fact that developers need some time and space to finalize various elements of potentially design, maybe even tender, maybe paperwork, maybe pre-commencement planning conditions.
We've got one at the moment where there's a client who's doing a barn conversion and they have to give a 3-month notice before pre-commencement for Heritage England to provide them basically, yes, you can commence. Well, that 3 months, someone's footed the bill for that somewhere, and it's got to be built in within the development finance. So they've had to take a 21-month term rather than 18 months.
Precisely. Party wall awards as well, for example, and pre-commencement planning conditions are probably the more painful ones because you can submit them, but you may be waiting
You don't know when they're going to come back.
months and months and months until they are approved. In fact, anecdotally, I have seen projects that reach practical completion with pre-commencement conditions still outstanding.
Yeah, we've got a few at the moment.
Precisely. And as long as they're submitted before you commence and there is some sort of positive noise coming from the council saying, oh, okay, we're reviewing, we don't have an issue so far, it's just a sign-off that's missing. I think lenders need to be a little bit more commercial and take some views around pre-commencement conditions. There is one I probably wouldn't take any views on is the construction method, just because it's all around health and safety and where do you store materials and where you have your machineries coming. You kind of do need to have that nailed down.
You can't kind of get around, is it? Whereas I think a couple of them, sometimes you can, for example, marking out, I'm trying to think what you would be marking out, but possibly roadways or pathways or public rights of access or things like that, where they need to see something of where's this going to go, where's that going to go. Some of those you can get away with because at the end of the day, they're drawn on the plans. You can't really go and amend them later down the line. But I think with the method of construction, when we've seen that come up a few times where clients have maybe gone to be a bit eager and then have had kickback, and it's just catastrophic if you decide to go and build houses.
There's a bit too much risk here, yes. And I think the lenders won't allow those developers to go, at least they won't fund it. The client can commence on site, but developers will hold back on this. Some of them are quite innocent, and you really, as long as it's submitted, as long as the monitoring surveyor review them, and they would tell us, they would say, well, we don't see anything onerous in here. It looks decent. They submitted. We don't foresee any issues. Most lenders will take a view and fund those.
And your MSQS, PMS, whatever you want to call them, they're there to basically advise you as the lender what's been submitted, what hasn't, what you can take a risk on, and everything else. If
they're not submitted and the client wants to commence, then I would probably draw a line here.
Yeah.
But as long as they have submitted and a few weeks pass by and there is no response just because the council is overloaded, I wouldn't be holding the client back. And I know it's a risk-based approach, particularly if we're all going to sit and wait for pre-commencement conditions to be discharged, nothing is going to get built.
Yeah. In terms of, again, speaking about delays, one of the biggest delays comes in sales. And we're seeing at the minute on a number of sites, there's just stuck. Where we found before, developers will come to us and they will say, oh, it's going to take us 18 months to build this out. Can we go for an 18-month term? And you sort of have to guide them a bit and say, well, yes, it's going to take you 18 months to build it, but you've also then got to refinance it or sell it or do something else. So you've got to have an extra 3 months, 6 months, whatever. So from a lender's perspective, how important is it that you've got those sales periods?
Well, there's a balancing act here, okay? Some lenders will be very happy to give you a short facility, knowing you will we know you're going to overrun. Everyone overruns. Like you never reach PC at PC, you never commence at commencement date, it's all overrun, right?
There's always something that crops up at the
There's always something. And it's a nature of the beast. Nobody is flustered. Apart from credit, who get nervous, nobody else in the industry get nervous, right? But if your loan is too short, that means you're going to be whacked with extension fees later on.
Yeah.
It's great when you have clarity and transparency around the extension fees, because if you do, you take that into account. You say, okay, I'm gonna take this on the chin, and I know it's going to cost me X to extend it, and I know I'll be extending it. The couple of issues coming here is as follows. First of all, if lender asks for evaluation and your GDV didn't go up as everyone hopes, and hopefully that we're never going to be in a situation, like if it didn't go up, then cash flow is going to be needed, and hopefully the client will have cash to bring to keep the gearing, to maintain the loan to values, loan to GDVs in. If they don't have the funds and the lenders get nervous, then this could actually be an event of default.
Yeah.
So if the GDV did go up and we're still within the covenants, so then all you're risking is your extension fees. Now, on the positive side, though, the shorter your loan is, the lower your interest tranche is, meaning the land loan goes up. And as we all know, what developers care about the most is the land loan.
Yeah.
And sometimes they're prepared to take that risk and get the higher land loan today, knowing they're going to be backed with extension fee later on. But equally, again, if extension fee is reasonable, you know your risk. You know exactly what you're entering into.
You can manage it, can't you? You can cash flow it. You can understand your risk versus reward, can't you? And like you said, I think every single developer that I've ever dealt with has always been more bothered about how much have I got to put in day one as opposed to am I going to be hit with a fee 18 months down the road? Brings us on to an interesting point in talking about cash flow. So from a lender's perspective, why is it so important that you have a view over that? And it's probably before even the QS, IMS, whatever we're going to call them again in this. Why is it important that you see that cash flow before they see it?
So what happens is the borrowers, sophisticated borrowers, will come and present the cash flow to us. More often than not, it's quite optimistic. They're going to build it really fast. They're going to sell it really fast. The sales overlapping the build.
Sales are going to start really early.
The sales start early. Everything flies off the shelf. Do they really believe in this? I think some of them do, and they need to. Yeah. They need to, because that's what drives them. That's what gives them the purpose. That's what they think they're going to get, because that maximizes the profit. Now, the first thing the lender is going to do, they're going to kind of tone this all down and cash flow the transaction based on what they believe the transaction will behave like. The reality is we cannot predict how the drawdown, when the process will commence. We cannot predict the drawdown profile, and of course we cannot predict the sale profile. We can make assumptions.
Yeah.
And those assumptions will influence the interest rate, the interest transaction, the interest tranche, and that interest tranche will influence the land loan. So while we see the client's prediction, the reality is every lender will build their own cash flow.
Why does it differ so massively? This is kind of the hot topic for now, isn't it? It's the number of lenders that we send deals to at 65% loan to GDV, and that net loan is just so different for everyone. And then you look at the interest tranche and you go, how can it be so wildly different? Now, obviously, I understand why it's so wildly different. Obviously, I understand the calculations behind it. But as a developer, what am I looking at?
I know. It's a dark magic, right?
It's something close to that, yeah.
How many of your lenders share the cash flows with you so you can see the assumptions?
One.
Oh.
And the one you used to work for.
I know. Okay.
I don't think we ever get a cash flow from, in terms of the spreadsheet that they used to do calculations. Yeah, I can think of literally one.
Okay. I think that is essential because that gives you the visibility into why the interest is calculated this way. Yeah. There's no right or wrong here, but if you think about the lifespan of the development finance deal, going back to pre-commencement period, 2-3 months pre-commencement period is fair, and we probably as lenders do need to assume that, because otherwise we default the client before they even started. Yeah. And during this pre-commencement period, your interest calculation should only be on the land loan. And in many cases, land loan is a teeny tiny fraction of your whole development finance facility. So there's barely any interest there. The second stage is your construction period. And let's say we assumed a reasonable construction period for this client. Normally it's an S-curve. They never behave in an S-curve. So whatever it is you do, whether it's S-curve or flat line, do make an assumption and calculate interest. But that development tranche is drawn in tranches, and it just increases month by month, and it reaches its peak at the very end of the project. So your loan is only fully drawn at the end of the project. Big question is what assumptions the lender made around the profile, the drawdown profile of this loan. And
whether you account for any sales as well, because if you've got that linear line of drawing everything down to the end of the project, paying full interest on that for the remainder of the sales period, you could be talking with some lenders of paying full interest on the full amount for the full sales period.
That's exactly it. So that's one of the biggest factors influencing the interest range. That's your sales period.
Yeah.
Ideally, you want 6 months. In the ideal world, you do want 6 months, right?
Yeah. And that's 6 months clear at the end of the development in order to sell everything. That's not 6 months during the development. That is 6 months. If you ask for 18 months, you're expecting 24 months.
Yes, so it's 6 months post PC for several reasons, really. First of all, PC is never achieved at PC, so you have an overrun. So even if you eat into your sales period, you still want to have a little bit of sales period left at the back end. And then the next question is what sales assumptions the lender made. If it's a housing project, it is fair to overlap sales. There's nothing wrong with overlapping sales. In fact, you can ask the IMS to confirm when the first unit is going to be finished. And 10 months is reasonable. And then you can start up. You can ask the valuer to comment on when do they think the units will start selling. Because, of course, the show home is going to be finished much earlier. So you can start marketing early. You can easily overlap sales, which significantly reduces your interest tranche. Now, that assumption about overlapping is, I want to say ballsy, but really it isn't. It's a commercial decision which is backed by professionals.
And what do you do when there's a shortfall on that? Because if you've assumed a certain amount of interest based on sales, if those sales don't take place, what are you as a bank doing at that point? Are you saying, right, okay, here's our growth facility. Because there have been no sales, we've then had to push that growth facility on ever so slightly because the interest is accumulating. At what point do you have to sit and think, actually, is this the right decision?
Yes. So remember that when the facility is structured, it's early days. All you can do is make assumptions, back them by your valuers and monitoring surveyors' opinion, and hopefully they support your assumptions. And you build this in the best way possible for the client. Now, going back to the previous point, the lower the interest tranche is, the higher the land loan is. It's give and take, and if one is low, the other one is high, there's going to be price to pay later on, right? So what happens when you run out of interest, and many facilities do run out of interest, whether the assumptions were a bit too aggressive, optimistic, or whether the project just overran or the sales a bit slow, there is several ways of dealing with it. If the market is strong and GDV went up, many lenders will just absorb it and allow the interest to roll.
That loan to value, aren't you?
Precisely, because it's still within your loan to value. If you haven't utilized your contingency in full, or in general, you haven't utilized your budget in full and you achieved some savings, which happens sometimes. So if you have any leftovers in your development tranche, you can always utilize that surplus to service interest. And of course, the worst case scenario is your GDV is not great or hasn't moved or remained stable or reduced. You run out of interest, you haven't achieved your PC, the sales are not coming as expected, you may need to service some interest. So that's kind of the worst that can happen, unless everything went completely and utterly wrong and the client and the bank is enforcing.
And how often do you find that your assumptions are different to the client's assumptions? I'd say every time, pretty much, I'm guessing.
Almost, yes. It's the clients are, they have to be, I believe they have to be optimistic to remain in the industry and keep building, right? So sometimes you see development appraisal that is just right. And you think, okay, they know what they're doing. They have done it before. They went conservatively. They want to structure. They don't want to maximize the land loan. They're not trying to artificially maximize the land loan. They're just trying to structure the deal exactly the way they need it to work, so that bank works together with the borrower. So those are rare. In most cases, we need to adapt the assumptions, and they need to be a little bit more conservative. But equally, to a degree, we know they're not going to reach PC on time. We know they're going to be cost overruns and surprises on the go. So by going a little bit more conservative, we are almost helping the client to be more comfortable later on in the process. But the price for that is your land loan goes down.
Just talking through, obviously, cash flow, everything else, let's get into kind of after the cash flow and everything else once we've kind of, I guess, gotten to the next stage, which is the conditions precedents, the conditions subsequent, and milestones. So they're called slightly different things depending on which lender you go to, but if you just kind of explain what the difference is from your side of things, and then we can kind of touch on what else they're called by other lenders.
Conditions precedent, conditions subsequent, milestones, and sometimes they're also called further conditions precedent to the development loan. Really good brokers know where to find them and how to work with them. And that's differentiate excellent brokers from everyone else. Conditions precedents are the conditions you need to satisfy before you're able to complete. They're typically listed in your offer letter or facility letter. Now, here are the good news, or the bad news actually. The bad news are there's lots of them. Sometimes you get an offer letter in and there is 25, 30 conditions precedent to be satisfied before you can complete your land loan.
Yeah, and this is complete the legals as well, isn't it? So just for anyone who's listening, just to clarify, this is before you can draw down that initial tranche.
The initial tranche, exactly. Yeah. So the good news are some of those conditions are really straightforward. So for example, things like KYC, passport, utility bills, assets and liability statement, clean searches, which hopefully the lender done quite early. Things like valuation, things like monitoring survey reports, etc. So some of them are really straightforward, really easy, part of the process. You would have done them anyway. And this is the good news. The bad news are some of them are quite convoluted and unclear.
Yeah.
Now, those are the ones you need to read really carefully, try to figure out what they mean. And if there's any ambiguity around what do they actually want, you go back to that lender, to the underwriter, and you ask them to tell you, what do you need to do to satisfy it? I'll give you an example. Let's say you have a transaction with an affordable housing arrangement, and the lender was not given clarity around specific constraints related to this affordable housing element. And let's say the transaction went to committee, and overall the transaction is favorable and committee liked it, but they didn't quite get this little thing here, this little element. So they will put something like lender satisfaction with social housing arrangement. Now this is very vague, and the big question is, what does it mean, lender satisfaction? What do I need to give you to satisfy you, or what satisfaction looks like in your eyes? Because the condition is coming from the credit committee. And by the time you go back to credit committee, you're going to be a week or days before completion. You really don't want to find out that they're not satisfied with your responses. So anything of that nature, go back and ask to be very clear about what do I actually need to do to give you satisfactory response. Because in order to complete your land loan, every single one of them will have to be signed off prior to completion. So you need to have full clarity, what do they mean? Now, the conditions subsequent are the conditions that needs to be satisfied after you complete. Unfortunately, from my experience, of many years of experience, everyone seems to forget about conditions subsequent as soon as they draw.
But they're the ones, actually, ironically, that can put you into default and everything else, can't they? Because some of them, if they're not done in time, could potentially be a default event.
B, 3 months down the line, you come to ask for your first development drawdown.
And you're not allowed it.
And you can't. Because there's another 17 conditions there that you were supposed to satisfy before your first development tranche. But unfortunately, quite often, post your first completion, the land loan drawdown, the broker disappears.
Yeah.
And the borrower suddenly faces with the offer letter that he read once, the lawyer explained it to them at some point, but they kind of forgot about it and they didn't realize there's conditions there to be satisfied before your first development tranche.
They get overexcited, don't they? They start going out on site and doing all of their
Precisely. So that's a little bit, it requires attention, it requires hand-holding from the broker side to the borrower to help them to satisfy those as well. And the same principle applies. If there's anything unclear, please ask the question early. And then you have milestones, and milestones are not linked necessarily to development tranche. It could be things like the first house is to be completed by month 10 post-commencement.
Yeah.
That is specifically applicable to, remember we talked about overlapping sales and construction. Yeah. So if the lender assumed you're going to have sales overlapping with your construction, they may add specific conditions to the offer letter to say specific phases, PC for specific phases, or maybe sales assumptions, 20% sales to be achieved by X and Y.
We've got one at the moment, which is barn conversion, which the lender has added in a condition that it has to be wind and watertight by Christmas. They've added that in because of the length of the loan and everything else, the complexity of the loan, and because also they did a larger day one loan than they possibly should have. But they've added in that condition of this needs to be wind and watertight by Christmas, because then they're starting to hit some of these milestones that you've mentioned in terms of getting out the loan in time. So they have added that as a specific condition on that one.
I hope the podcast goes out after you complete on that barn
We've already
conversion.
completed.
Oh, okay.
it's there's now a race against time to get that
Yeah,
one watertight by Christmas.
It's a good example of a milestone, but equally, if anything in that offer letter is unrealistic or unachievable, that will default the client.
Yeah, and you need to know before you complete as well, don't you? Because once you've completed, there's no negotiation on those conditions realistically.
Sometimes yes, and some lenders are quite linear, but also that will give the lender grounds to default the client. In most cases, the lenders want, and they will work with the client.
Yeah.
But if there's anything there that you just know you're not going to get, and you know it's going to stress you out, and you know it's not achievable, you need to communicate to the lender back, because it can be, in the ideal world, you want to match the development finance proposition to the client's requirements.
Yeah.
And there's no point in wrapping them in really tight timescales that just cannot be achieved.
Yeah, because it's setting them up for failure straight away, isn't
Precisely.
it? So, in terms of just coming back to acronyms and different ways that things are named and what means what. So just to wrap up this part before we move on to part 3. So net loan to GDV versus gross loan to GDV.
Oh, okay. That's a big topic. So as we discussed previously, there's 50, 60, 70 lenders out there, maybe even more. And they all do development finance a little bit different. But let's just separate them to 2 categories. This first category will have land loan or land loan day one or property tranche or lots of names to it, land tranche. So there's property tranche, there is development tranche, and there is interest tranche. So when you have all 3 tranches together, lenders would tend to call this loan to GDV.
Yep.
They won't call it gross loan to GDV, they just call it loan to GDV. But what matters is that all 3 tranches are in. Yep. So the interest tranche is accounted for. There's a second category of lenders where they would just give you land loan and they will give you development loan.
Yep.
And the interest will be left out of it. It's not right or wrong, it's just the way they operate.
Yep.
When the interest is left out of it, from lender's perspective, they would say, well, we don't know exactly how your loan is going to behave. We cannot predict how you're going to draw funds, which is true. None of us can. But we are restricting our loan to GDV to a lower level. So we don't go to 65 like everyone else.
They go to 50,
We'll go
example.
to 50, 55, maybe a little bit more. So our starting point is a lower starting point because we allow for that interest to happen later on in whatever fashion it happens later on. Now, those lenders would typically call that loan to GDV net loan to GDV.
Yep.
And that helps you to look deeper into the terms just to see whether the interest was included or excluded. So in most cases, it would be excluded. Now, the beauty of this way of structuring the facility is that quite often you will not have a gross loan to GDV covenant.
Yep.
Meaning that your interest can just accumulate in whatever way it does, for as long as you're within your term, you're not actually in breach. So you don't have that constraint around, you cannot exceed X, Y, Z.
Well, and also so just to explain from a developer's perspective as well, the first scenario you mentioned is what is known as, I guess, retained interest is probably what they would call it. And then the second scenario is talking about rolled interest, and actually just sort of touching on the interest side of things, it actually ends up slightly cheaper to a degree because the way that they calculate the interest, obviously with retained, is that they work it off their gross loan to GDV or their 65% and then work the interest off the full facility, whereas the net is working the interest off that net figure that they're using. So you're not actually then paying interest on, because with the gross facility, you end up paying interest on interest potentially and interest on arrangement fees and everything else for that term.
You end up paying interest on interest in both cases because when the interest is charged, it then it's added to the full debt, to the rest of the loan, and then the interest is due on it, unless the client services interest, but nobody services interest in development finance.
No.
And it's also not really in the client's interest, it drains the cash flow. So the interest on interest is going to be paid in both scenarios. But the fees in the gross scenario, they're paid on land, development tranche, and interest tranche. So your 1% here is actually higher than your 1% here on a net loan to GDV.
And to put it on a number, if we just put it in its dumbest format, I guess, if you've got £1 million GDV, scenario 1, 65%, you're going to end up paying £6,500 as a 1% fee, whereas on this side, 50% loan to GDV, you end up paying £5,000.
Exactly.
In its most rawest form, obviously, there's more to it than that.
Exactly.
But as a rule of thumb, you end up paying £1,500 less on
No, and the funny thing
essentially
is,
the same borrowing.
Precisely. The funny thing is when people compare terms, the net and the gross, it's sometimes even people in the industry, they look at it and think, oh, I don't, what do they mean net? What do you mean net from fees, net from that? And then you need to look into tranches and need to look what's included and actually calculate the amounts you pay in fees and interest just to see where does it fit, how does it compare? And it makes it difficult to compare terms from different lenders. The one point you mentioned is retained interest. In most cases, it's not retained. The interest tranche, even if it's included in the 65% calculation, it's just an estimate of where lender thinks your interest will end up.
Yeah.
They're not drawing it on day one and holding it aside because that would be quite penalizing to the client.
Yeah.
But they're just almost treat it like a credit line, almost allowing a credit line for that amount. And every time the interest is due, it's just going to utilize from that credit line. Yes, but it's not drawn on day one. It's just almost kept aside as a limit to utilize as you go. So that's a difference, gross and net. But the unhelpful thing is the gross is often not called gross. It's just called loan to GDV.
Yeah.
While net would be called net.
And every single lender, I think, does it completely differently. And we end up, again, we love a spreadsheet. And again, we have a spreadsheet which kind of calculates all of the overall costs. And it's quite funny the number of times a client will look at maybe a gross loan to GDV, and we'll call it that for the purpose of this. They'll look at that might be 0.95% a month. This one over here on the net might be 1.05. But actually, when you work out the costs, ironically enough, the 1.05 ends up being considerably cheaper. And the amount of times a developer will look at it and go, oh, well, that one's 0.95. I want to go for that one. And you go, well, actually, here's a nice little spreadsheet that kind of shows it. And a number of them are surprised, I think, at how much cheaper it actually is. And yeah, it's very much, don't just take the headline interest rate and run with it. It really is work out the fees. Exit fees as well is a huge one.
100%.
The amount of people who completely forget about exit fees. Yeah, and it just baffles me how anyone can forget such a fundamental cost when looking at these terms. So, I think it's really important to understand those differences and to analyze those costs in full, I think.
This is the value brokers bring in, because then you can break it down to pieces and present it.
We're all about saving money, aren't we? In theory, a broker should save more than they cost. Whether they do or not is a different conversation.
Hopefully.
But
fingers crossed.
But they should, in theory, save more than they cost overall, I think. And that probably brings us to quite a nice end, I think, for part 2. So let's get prepped for part 3. Thank you very much for everyone that's listened. See you on the next one.